Chapter 6 is on variable costing and segment reporting. And the first thing we're going to do is look at variable costing and compare it to absorption costing. We will use actual costing rather than the normal costing approach that we've used for job order costing chapters. We will use the actual number of units produced as the allocation base. Variable costing will separate the costs out into product costs and period costs. Product costs are direct materials, direct labor, and variable manufacturing overhead only. Period costs are fixed manufacturing overhead and both fixed and variable selling and administrative expenses. With variable costing, they use variable manufacturing overhead as a product cost that's attached to the product in inventory. Period costs are expensed out each month. Fixed manufacturing overhead under variable costing is a period cost and expensed out each month instead of attaching to the unit sitting in inventory. Under absorption costing, however, you still have the same direct materials, direct labor, and variable overhead. But then you also have the fixed overhead. Absorption costing absorbs all of the costs that has to do with the product. The only period cost would be the selling and administrative expenses, both fixed and variable, that are expensed out monthly. Let's take a look at Harvey Company. They produce 25,000 units annually. Their variable cost per unit is $10 for direct materials, direct labor, and variable manufacturing overhead, and then $3 for selling and administrative expenses. Their fixed costs are $150,000 for manufacturing overhead and $100,000 for selling and administrative. To get the unit product cost under variable costing, you take that $10 of direct materials, direct labor, and variable overhead. To get the unit product cost under absorption costing, you have that same $10. But in addition, absorption costing absorbs all of the costs, so the fixed manufacturing overhead is included. Take the $150,000 fixed manufacturing overhead, divide it by how many units, and you get $6. The unit product cost under absorption costing is $16. Looking at an income statement for both variable and absorption, we're going to look at the fact that 20,000 units were sold. There was no beginning inventory. They produced 25,000 units and 20,000 units were sold. They sold each unit for $30. $30 times $20,000 is $600,000. The variable cost of goods sold is the 20,000 units they sold times that $10 unit product cost. That's $200,000. Variable selling and administrative expenses, 20,000 units times $3. Gives you a total of $260,000 variable costing. Subtract that from the sales, contribution margin is $340,000. The two combined fixed costs are $250,000, which is fixed manufacturing overhead and fixed selling and administrative. Subtract that from the contribution margin and you get net operating income of $90,000. Now, just to kind of recap the difference between variable and absorption, this fixed manufacturing overhead is a fixed expense under variable costing, and that is going to make a difference in the net operating income. Here's the income statement for absorption costing. You have the same sales, and then you subtract cost of goods sold. Cost of goods sold is $16. Under variable costing, the cost was $10. Under absorption costing, the cost is $16 because it is including $6 of fixed manufacturing overhead. The net operating income under absorption costing is $120,000. That is a difference of $30,000 from variable costing. So that difference is $30,000. Okay, let's look at why the two differ. Absorption costing absorbs all the cost. So in the $16 is that 5,000 units still left in ending inventory. And within those 5,000 units in ending inventory is fixed manufacturing overhead of $6 per unit. Because the fixed manufacturing overhead is a product cost, not a period cost, it has not been expensed out yet. It is still sitting in inventory. That is why the net operating income is $30,000 more. But with variable costing, that $30,000 of fixed manufacturing overhead was expensed out because they treat it as a period expense. Okay, let's look at what happens here. You see that everything checks out except for the ending inventory. Ending inventory under absorption costing is valued at $80,000, and ending inventory under variable costing is valued at $50,000. In year 2, that $30,000 difference will actually go the other way and balance each other out. We'll look at the same thing. However, this time in year 2, we have $5,000 5,000 units in beginning inventory that we didn't have before. This is the 5,000 that was sitting in ending inventory last year. We still produced another 25,000 units, but we sold 30,000. So we sold all 25 that we made, plus we sold the 5,000 that we started the month off with. We still have the same unit product cost, $16 for absorption costing and $10 for variable costing. In year 2, your net operating income ends up being $260,000. With our increase in sales and then our variable cost of goods sold and our variable selling expenses gives you a contribution margin of $510. Subtract the 2 fixed expenses, this is the same that we did for year 1. We get net operating income of $260. Now this $260 net operating income is including that $30,000 that was sitting in inventory last year that is now expensed out this year. So the net income under variable costing is going to be $30,000 more. When you calculate the absorption costing net operating income, you get $230,000. And that is $30,000 less than variable costing. In year 1, absorption costing was $30,000 more because it had costs still sitting in inventory not expensed out yet. Now in year 2, those units have been sold. So their net operating income will be $30,000 less. Variable costing will be more because they already expensed out that amount the year before. The first year absorption costing was more. The second year variable costing was more. But when you add the 2 periods together, they both equal $350,000. So it all equals out in the end. It's just that fixed manufacturing overhead under one period will be expensed out, and the other period it's still sitting in inventory. Okay, the second thing that we're going to do in this chapter is to look at traceable fixed costs. And we're going to trace these costs to different segments of the business. A segment is just any part or activity of an organization that a manager wants to keep track of its cost and revenue. This could be an individual store, a service center, a sales territory. And traceable fixed costs should be separated from common fixed costs so you can calculate the segment margin. A traceable fixed cost is going to be traced to a division, to a store. And common fixed costs, you cannot trace to a certain part of the business. Therefore, it sits there in the company section and not in each division. An example of a traceable cost would be the salary of the Fritos product manager at PepsiCo. That's a traceable fixed cost because he is the manager over the Fritos business segment. Another example is the maintenance cost for the building in which the 747s are assembled. That can be traceable to that actual building. A common fixed cost would be the CEO's salary of General Motors, because the CEO is over all of the divisions of General Motors. So that is a common fixed cost for the entire company to absorb. A second example would be heating at a Safeway. You're going to heat the whole store, not just part of the store. So that's a common fixed cost amongst all of the different departments. We need to make sure that we really look at what the traceable and common costs are, because some traceable fixed costs in one segment could be a common fixed cost in another. Take a look at the landing fee paid to land an airplane. That landing fee that they have to pay is traceable to that flight, but it's not traceable to the different sections of the airplane: first class, business class, economy class. Common costs you do not allocate to the segments. And we're going to look at Weber Incorporated. They have two divisions. They have the computer division and the TV division. This is a contribution margin format for income statement for the TV division. They have a division margin of $60,000. So they take the sales, they subtract the variable cost of goods sold and other variable expenses, and they get the contribution margin of $150,000. Then they subtract the traceable fixed expenses to give you a division margin of $60,000. Now let's compare that to the other division, which is the computer division. The computer division has a division margin of $40,000, which gives us a combined total division margin of $100,000 when you look at the TV division and the computer division. Okay, now let's talk about those common expenses. This company has $25,000 of common expenses. That $25,000 is not going to be allocated to the TV division, and it is not going to be allocated to the computer division. It's going to be separate because they're common between both. Subtract that and you get the net operating income of $75,000. Okay, now we're going to look at one division, and we're going to look at different product lines within the TV division. The TV division has regular or big screen TV, and we can go down to the product line margin. The regular TV has a product line margin of $60,000, and the big screen has a product line margin of $10,000. Let's look at the common expenses. The common expenses are $10,000. So within the TV division only, there's $10,000 of common expenses. that $10,000 cannot be allocated to the regular screen or the big screen. Okay, let's look at the break-even point. We've worked with the break-even point before. The only difference here is to get the break-even point in dollars, you take the fixed cost and divide it by the contribution margin ratio. The difference here is we have two fixed costs. You want to make sure that you take the total traceable fixed costs and add the common fixed expenses to it as well. And then you can do the same thing for each division. You can calculate the break-even point for the company, and then you can also calculate the break-even point for each division to see how profitable it is. You want to make sure that you trace your costs carefully, because you don't want to take a cost and put it in a segment where they are not responsible for it. So just make sure that you don't hold them accountable for costs that they cannot control. And then this is the end of chapter 6.